Mr. Gama Rose, is it right pronunciation?
Super pronunciation.
Excellent, thanks. Could you please explain why the high yield sector is now attractive for you?
First and foremost, Peter, it's the all-in valuations are now at compelling levels. History tells us that for an investor that invests over 3 and 5 year basis, when yields are at current levels, they usually make positive returns. So that's first and foremost. But also, fundamentals are in a very strong starting point. And even though we expect deterioration, the strong starting point will really manage to keep defaults lower than previous peaks. And then finally, technicals are very strong. Not a lot of issuance, and inflows are expected to come back.
But you also mentioned that the investors should be careful not to put everything in high yields. Why?
So I think obviously good portfolio management is diversification across a number of asset classes, but even within high yield, you need to invest in a very diversified approach. So I would still say have exposure to lowest rated credit, but very aware that you're more tilted to the higher quality parts of high yield. So that's the single Bs and double B rated parts of high yield.
You mentioned 3 different high yield funds you're managing. Is there a specific strategy to pick up interesting high yield bonds?
So we have European high yield funds, and we have 2 global funds. Both have quite a number of options on a single company sector basis. I would say first on Europe, it's less exposed to emerging markets than the global funds. So, but overall, both universes give good diversity. In terms of opportunities, in this year, we expect good opportunities to come from the primary market. So these are bonds that are primarily going to use for refinancing, coming at good yields, and also from just looking at dislocations in the secondary market, and where sometimes sell-offs on actually survivor balance sheets, good companies are opportunities to add in.
Excellent. Thanks a lot.
Thank you, Peter. Thank you.
Thank you.